Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. For the next hour, Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
And I'm Guy Allard. We are coming to you from the Star,
That's
as
right.
I understand it, in Frisco, Texas. One of the fastest growing, best places to live in the country right now.
And now that the Cowboys whipped the crap out of the Jaguars, I could say home of the Dallas Cowboys. I didn't want to say it last week.
I saw it must have been a Cowboy hater, certainly not a fan.
An un-American.
That's
right.
They had a
non-patriot.
They had a picture of a Cowboys helmet with the Cowboys blue star on the side, and they said, no, that is not a logo. Below it, they had 5 whited out stars. They say that's a rating.
Rating?
1 star.
Oh, man. Who is that unpatriotic person?
Oh, I just got to let it go. It's a troll.
It's been raining. It won't stop raining. The market won't stop going up and down. Very volatile. Somebody asked me, they said they go, I just transferred from Seattle into this. And I go, I'm a stats nerd kind of thing. And
go ahead.
Like in Seattle, it rains pretty much it's a light drizzle mostly, but you might get 30, 35 inches a year. We got like 25 inches in the last month and a half.
Oh, we're way ahead of schedule.
It's crazy.
Quick Seattle story. We've got dear friends, Greg and Val, that moved to Seattle 5-6 years ago. Both their kids are up there. He's a conservative fella. And he said
not the place to move to.
He said that place is so liberal. They have one day a month on the town square that is nothing but for protests. One day a month. That's a weekend day. Everybody gets together and they get to go down and they get to protest. He said it's awesome.
I actually, like I said, I was in the military. Everybody knows that. But my best friend that we grew up, he also went in the military at the same time. I was a nuclear chemist. He was a missile technician. One of those guys that actually pushed that button.
Right.
That if you don't push your button, the other guy gets to shoot you in the movies.
1 and 2 guys? Yeah.
And I asked him if that was true. He goes, yeah, it's true. I go, really? This is your buddy you've been working in for the years, and you got to shoot him? Yeah. I was like, wow. That one I don't know if I could do. That'd be tough, right?
That's a tough job.
But we're up there, and he was stationed up in Bremerton, which is right by Seattle in that whole Puget Sound area. But it is, I was looking at houses up there when I was in the military. And this was like 2 acres on Puget Sound. They were like $60,000. Back in the 80s, I was like, oh, it's got a bit of money. The lots right now are in like $5 to $10 million.
Yeah, it's crazy. Right?
And this was on the ocean, right on the Puget Sound.
It's just beautiful.
But it's it's great up there. But the weather is. Last time I was there, it was actually sunny for like a week. But
well,
depressing, kind of too much cloud cover all the time.
Try to stay away from politics and religion, but. Their homeless rate is crazy. They got to put armrests on their city benches so that people don't use them for for beds. I mean, the minimum wage they're trying to force, the corporate taxes it's difficult.
Oh, I love that one person was on the news that said we put purple lights on all of our porches to show that there are no guns in this home. I was like, whoa. Isn't that a target? No.
You might as well just make a neon light. Robbers
now they're, I heard
it's a sanctuary house. I get it. Purple light. It's a sanctuary house. All robbers are welcome. Come on in.
Now Hollywood is starting to ban Snow White.
I heard the prince didn't ask permission
That's
for
right,
a kiss.
Prince didn't ask permission for the kiss. I'm not going to go into this because every time we do, we get crazy calls. I'm just saying that's a little overboard, don't you think?
But on the lighter side, I did hear that Snow White had a little native Indian blood in her.
Oh, gosh, please.
That was like 1/1000th or something, but she's got a little Cherokee in her.
My grandma always said that. They always go the Cherokee one.
Is that
Have
what
you
it
ever
is?
noticed that? Oh, yeah, my grandmother, and I'm like, we did that testing thing. My son did it, actually. Didn't really show any Indian at all.
None.
My grandma said, well, that's a false test. It's not right,
I believe my wife does. I don't know how much, but I have to send it away. But she's been told by her family.
Yeah. I mean, she's got more likelihood than, my Irish side. She's got some likelihood there could be some Indians in there, right?
You always say, I've got red skin. Does that count?
So, well, today, the market is, interest rates going up does make the market go down. Good employment, increasing wages, makes the market go up. But the fact are, we're at 9.5-year highs of the stock market. One way or the other, it can keep going up for a while, but it's going to have some kind of correction. It has to. A correction is healthy for the market because it's going to, what you got to do is your earnings have to catch up. Remember, everything goes overboard. It'll go up too long or down too much.
Some individual stocks are down 25% right now, and their earnings are getting about right.
So you got to be careful. Just if you have your allocation correct, if you've got your bucket strategy in order, if you've actually done the planning instead of kind of shooting from the hip, which too many people do, you don't have to worry about these fluctuations, even though they're getting a little scary. I mean, I had a bunch of calls this week. Are we okay? Are we okay? Oh, my gosh. It was actually from last week that the market went down 1,100 points or whatever.
Yep.
Then it went up part of this week, then back down. You know, it's all over the place.
Very volatile.
But if you look at it from January, remember last year it made like over 20%. From January, the market is about the same all year. It's just gone up like 6-8%, 7-8, then go down. Blah, blah, blah. It has gone back and forth where it's about even.
And everyone has a tendency, us included, to kind of follow our beliefs and support our beliefs information-wide. I would suggest, and it's just a suggestion, the folks, and there's a lot of them media-wise, that dislike the administration, immediately jump to the tariffs and the issues that we have there. But do you realize out of the $600 billion deficit we have, every $200 billion that's lowered increases our GDP by 1%. So I would say that is something they're trying to couch it on. Now, there's many reasons, and you can do your own research. Some of the ones that I tend to subscribe to and have heard is the EU and the banking, and a lot of them they spiked Thursday. A lot of them are having some issues. Little known fact, who would have thought? Italy is like the third largest player in the international bond market. You wouldn't have thought that. They are a large player in the bond market. They're having some issues. We talked about it 3, 4, 5 weeks ago, and we used the analogy of a neighborhood. Right now, the United States is the nicest house on the block. While it's nice to have the nicest house on the block, if it's way too nice, all the other houses will drag the value of your nicest house on the block down, more so than vice versa. So there's some banking concerns right now. If the EU and the international community has issues, it will affect us.
What is the Chinese market down now? 30%?
I heard that a week ago.
Yeah, it's down a bit. We're still the strongest economy out there, but everything is kind of intertwined. It is.
For sure.
Even if you don't want it to be, it is. Because it's just like some of the cigarette companies, they sell a lot more overseas than they do here, even though they're American companies. Coca-Cola's like that. They sell more overseas than here. Like the cigarette companies, a whole bunch of companies like that. You just don't realize.
I don't even think Levi's are made in the U.S. anymore.
No, probably not. We probably buy more here, though, but who knows? Everything's kind of everywhere now. And so I don't know if tariffs or anything. I look at just long-term stuff. I don't know what the trigger is, but nothing goes up forever.
And you never know, right?
That's right.
You never know.
There's going to be a trigger. There's going to be some reason. It always going to, and the same vice versa. If something's going down, there's going to be some trigger or something to stop it and make it start going the other way. And some people don't mind it. If you're 30 years old, remember the market's all over the place right now, but it actually hadn't done anything this year, not up or down. And so if you're okay with that, just stay with it if you have that kind of nerve. Now, what happens is as we get older, people want to have things safer and safer. They start seeing their own mortality, start seeing the end of the tunnel where they're going to quit working, the paycheck's going to stop, or they're already in that retired mode. And so they're going to be more affected by stuff like this. Or they're going to feel more affected. But I'm telling you, if you have your stuff handled correctly, you shouldn't affect you at all. You want to make sure, don't get me wrong, if you're in stocks and they go down, you're going to lose money. But if your overall plan's in place, you still should be okay. You just got to make sure, don't sell on the downs, because nobody ever sells at the top and buys at the bottom. I know that's the whole thing you're trying to do, right? Nobody ever does it. What happens is it goes down, And then you sell it after it's already gone down, right? So you didn't get out the top because nobody does. And then when it starts going back up, well, you want to make sure it's not a false rally. I just saw it go down last week, 20%. So you wait for it to go up. So you miss most of the rally.
And how do you do that? Don't get overexcited when it's going up. Don't get overexcited when it's going down. Your age is the percentage that you should have safe.
Yeah. What we're going to do today is we're going to talk about, I'm going to do a little bit of 401k allocation. We're going to try to break down some different kind of annuities because everybody's coming out with a different article on annuities now. What's good, what's bad, all that. So if you have any financial questions, don't hesitate to call us. Remember, you can take advantage of our no-cost, no-obligation retirement analyzer, Social Security optimizer, 972-715-2424. Again, 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is always based on facts instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. All right. Let's talk about how to allocate a 401k. I see this, allocations that have some danger that really shouldn't, but I'm seeing it a lot lately. People spend less time, like I said, like 100 times more actual time planning a vacation than going through the 401k stuff. They might look at it once, do something, and here's what everybody does. Let's say you got 10 choices. All right, well, let me get the one that did. I don't want that one that didn't do too good. Okay, here's 5 of them that did real good. Okay, we'll pick that. And sometimes you'll find the person puts almost all of it in that one, or the other one, I'm going to split it up evenly between these 5. The problem is, if one asset class has outperformed another like it has the last several years, you have the same thing in different packages. So your risk is actually concentrated and goes up exponentially. You don't have diversification.
And I mentioned one brief thing before you get into it. If you're looking for diversification, speaking from our choices, my wife's 403B, which we have limited choices, our 401ks, it's not like you have the complete universe of things. We talk about your age should be the percentage you should have safe, the rest at risk. Your 401, your IRA, those are forced income streams at 70.5, right? You have to take required minimum distribution, so you've got a pretty far time horizon on those for those to grow. It's okay, in my opinion, if you use your safe money, if you did some of that perhaps with your non-qualified where you have better choices. Reason being, in this day and age, Victor and I have talked about it over and over. Right now, bonds are not where you want to be. Interest rates, the Fed is aggressively going to raise interest rates. Existing bonds that you hold, the value will go down if you don't hold them to term, because you'll have to sell them at a discount because I could go out and buy a newer one at a higher rate. And the short term or the front end of the money, the yield curve, is really non-existent in 401ks. There's no options. The short-term funds, the fees are actually more than what they cost for you to. You actually guarantee yourself to lose if you're trying to use part of your money in your 401k to secure it and protect it, which is really counterintuitive. So if you have a way to take that secure money and do that elsewhere, perhaps with a non-qualified, and use the 401k more for a growth, diversified, certainly steady, long-term horizon, depending on your deal, you're probably better off than trying to re-diversify into safe stuff in those choices.
That assumes you do have stuff outside of the 401k.
Then you're
going to have to allocate within it in that case.
There you go.
So that's the one risk you have right now. Interest rates going up make bonds go down. Another risk you have, let's say you've got a 401k and it's got 4 different choices for fixed income. That would be your bond stuff, right?
It's pretty much all the choices they give you, right?
Right. And what they're going to have is you're going to look at the 1-year return, the 5-year, the 10-year return. You're going to look at all that stuff like, okay, I'm going to put half my money in this bond fund because this one made 8% a year.
Over the longest period of time.
That's right. I go, so I'm researching here. I'm going longer.
Yeah.
The problem is that thing is probably rife with non-investment grade bonds. Used to be they're called high yield bonds. Also called junk bonds.
Opposed to junk bonds.
Same thing.
Right.
So a junk bond, non-investment grade bond, and a high-yield bond are the exact same thing.
Think Chicago, Illinois.
Puerto Rico's got a great...
There you go. Great rate for Puerto Rican bonds.
They've got those kind of bonds. They've also got the longest maturities. Because in other words, you buy 30-year bonds, you get a better rate typically than a 5-year bond, right? So those are going to have the higher ones. So when you're in a rising interest rate environment, you want to get away from the ones that have made the most. I know this sounds counterintuitive, right? I don't want to buy the fund that's made the most. Don't want to. I was looking at one of my clients sent me their 401k choices. It's a big company here in, I'm not going to say where it's at.
You almost did.
But I will say Vanguard is the trustee. So there's a lot of Vanguard funds, which I love.
Which is a very good company.
Absolutely. Love Vanguard. And they had like a fixed fund, like a money market. Now, that money market is paying like 1.8%, which is not bad for a money market, right? Well, the safe side of this, let's say you're 50 years old. So we want 50% safe. Remember, 60 years old wants 60% safe and so on. Well, right now, until interest rates stop going up, getting out of those bond funds, putting into that money market at 1.8 should return you a lot more than anything else.
This was an option available in the 401k?
Yes.
That's a good option.
Right. So that's one option there. If you're one of the government, you got the G fund. Right now, it's your 457s and things like that. G fund's similar. It's like a set account. That one is a short-term, based on short-term rates. It's not going to go down if interest rates go up. It should go up with interest rates. So that's a good place for those. Get out of any high-yield bond funds or anything that's made quite a bit the last few years. Because remember, we're in a 30-year period where interest rates are going down, so bonds are going up. So the ones that made the most are the highest yielding, the longest maturities. You got to get out of that kind of stuff. So my first advice with a 401k, get short bonds or money markets if you have that access to that. Sometimes they'll have just a fixed account or a savings account, they call it. Whatever it is, those are good. Or very short bonds. How can you know if your bond funds you have choices on in your 401k are short or long? You can look them up like Morningstar. There's several websites. Go type in the fund and look at the allocation of it and see what the maturities. If the average maturity on the bond funds is, say, 14 years, that's too long. If it's 2 or 3 years, that's okay. Because short bonds don't go down with the interest rates going up that much. All right, we're going to talk more about how to allocate your 401k. When we return from the break, stay with us. Remember, also, if you have any financial questions, we also offer the Retirement Plan Analyzer, the most comprehensive software I've ever seen to make sure you're not going to eat cat food when you're 80. Call us go ahead. And we have some great stuff that'll pay 6 to 8% if used for income that's guaranteed. That's right, 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back to the show.
It's good to be the most experienced at something. Hey, just before we went to the break, Victor was talking about bonds and the rising interest rate environment. I just wanted to give a little supporting information. If you love charts like we do, or if you don't, Google the Fed funds rate, and you can see the chart. And just before the market crashed in 2008, it looked like a 2-story stairwell where each quarter it up to the peak, and it couldn't take it anymore. And boom, that was one of the contributing factors. And the Fed would have you think we're in that direction now. Now the argument against that. Back in the old days, there was only 3 TV stations. I mean, you didn't have a lot of competition. You had the inflation could get rampant. They could get together. Now there's so many different choices and options on the internet and brick and mortar and all of that. It's a little bit more difficult for that inflation to get out of control.
Just make sure. So keep low maturities. In other words, short-term bond funds are okay. Money market's okay. Fixed account like a G fund's okay. Stay away from any of your high-yielding stuff, anything that's made a whole lot in the last few years, for that safe allocation. This is if you can't allocate safely outside. One of the reasons why Guy brought up, if you're going to take risk, the 401k is not a bad place for that risk. It's better than a static account is this. If you're always adding money into a 401k, you're always dollar cost averaging. Perfect. Stocks are going down, you're buying stocks at lower prices. Your company's matching you, buying again at lower prices. So therefore, even when a market's pretty volatile, it is tough to lose over a long period of time in a 401k. So if you're going to take the risk, take it in that one. Now, a static account, remember the market goes down 50%? It's got to go up 100% to break even. But it's different on a 401k. You can, like I said, because you're always adding funds, you're always adding money. It is tough if you don't have it automatic. I'll give you an example. You own this mutual fund. Let's say it's the only thing you had. It went down 50%. Do you feel like taking out more cash and buying some more of it, and you just lost half your money in the thing?
It's on sale.
That's right. No, nobody does. Even though
That's right.
that's exactly what you should do.
That's right.
Nobody. Human nature will not allow us to do it. So 401k does it automatically.
That's one of the single most important reasons to have an advisor, to have someone like Victor and I or McClure Capital help you. And that all the economic professors, we talk about it almost weekly now because it's important behavioral sciences as far as investings go. It takes the emotion out of it, and that's where we can really help you guys.
So that's the first thing we do is get the safe money safe inside the 401k if we have to, right? Next thing to do, all right, how are we going to pick equities? Well, think about it. What's logically the best part of if you're going to buy stocks, what would be the safer part? Even though all stocks have risk, like large companies,
large cap, right?
So larger cap are safer than small cap. Small cap give you more potential return, right, but more volatility.
That's right.
Well, who's safer, United States companies or foreign companies?
I would have to go with the United States companies for 100, Alex.
That's right. So, what would I look for? I would look, if you have choices in your 401k of index funds, large cap U.S. income funds, like a Vanguard 500, S&P 500 fund. Fidelity's got them. Every company I know has a S&P 500 fund. That represents every industry in the United States. People mistake the 500 largest companies in the U.S. It's not the 500 largest. It's 500 very large that represent all the different industries in the United States. And that right there, the S&P 500, supposedly is 70 to 80% of the capitalization of the entire U.S. stock market. All the, all those NASDAQ companies and all that. So that is a great place to go next.
And they're getting beat up right now, NASDAQ.
Right. Stay in an S&P 500 type index fund. So I'm looking for low cost. I'm looking for domestic. And that's going to be my next big chunk. So your safe chunk, that's going to be the next big chunk, right? Then the next one would be, I know this is weird, it'd be an international fund. But do I want a small bank?
Have to?
Yeah, no.
Do I have to?
Do I want a small bank in Paraguay? No.
Right.
That's for a small, tiny percentage. And now, Mercedes-Benz is a foreign company. Toyota is a foreign company, right? Oh, those are pretty good. So have some of that in there. Believe it or not, by adding some international, it's historically been proven you increase your return and at the same time simultaneously decreasing your risk. I know if you ever want to see it, I'll show you. American funds used to have a good
I don't
thing
like
in
it.
So you got to have some of that. Then you start getting your small cap, mid cap, things like that. That's the way to allocate a portfolio. The problem I'm seeing, the biggest problem I'm seeing, everybody's going to default target date funds. In other words,
yes.
I'm going to retire 2020 or 2030, put it in the 2020 and 2030 fund.
Expecting them to do all the work
That's right.
for you.
They're going to do all the work. To me, there is huge danger in those things. I've never liked them from the beginning because I remember in 2008 when the market crashed, right? 2008, the 2010 funds went down almost 50%.
2 years to retirement.
That's right. We'll talk about that more after the break and why don't choose a target date fund, even though that is the default option for everybody now. Give us a call if you have any questions, 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, the home of plain-spoken, no-nonsense answers to your financial questions.
Welcome back to the show. This is the How to Allocate Your 401k show.
And just before the break, you were telling everyone how much you like time date funds.
Target date funds, right?
Them too.
I think Fidelity is one that came out with the original one. I think the Fidelity 2010.
It's a great idea.
Yeah, it's a great idea. And the whole theory behind it is, okay, as you get closer to retirement, we're going to have the money safer and safer, and prepare it for the distribution phase of your life when you retire.
How come they don't do that part of it?
What happens is, the problem is, these are the most popular funds in the world now because it's easy. People don't want to take time to allocate 5 or 6, 10 mutual funds. So just put it in there. The problem is they all compete with each other. Okay? What do I mean by that?
Rate of return.
Everything's based on rate of return. If I've got let's say I'm a PIMCO target date fund, but I'm a Fidelity target date fund. Well, the Fidelity target date fund has made 3% more a year than the PIMCO target date fund. What it means is they put, if the asset class that's working the most, let's say it's large cap, let's say it's technology, it makes them have too much of it in there. That's why the average target date fund for 2010, when it was less than 2 years to retirement, lost over 40% in 2008 because they had too many stocks in it. Because they're competing with each other. Nobody's going to buy my target date fund because people are just looking as a 2010 fund, and a 2010 fund, this was made a lot more than this one. Well, it could be because this was safer than this one, right? People don't pay attention to that.
They don't.
They're thinking it's the exact same thing. It's 2010. I think this one's just crap, and this one's good.
And a real good lesson here, if nothing else, as you apply to everything you do. And we tell our interns here all the time because they get new people on the phone and they try to tell them how wonderful we are and how we can help them. The first thing they want to do is get in a conversation. Well, what rate of return are you getting with the firm you're with?
Right.
You can't shop rate of return. That's only one small piece of a multifaceted puzzle.
Now, don't get me wrong. If you had the exact same mix of stocks and bonds and one outperforming the other,
absolutely,
definitely choose the higher one.
Absolutely.
But people don't go that far. So target date funds, since they have to compete with each other, and these managers will get fired if they do not produce returns for their asset class or their category.
And they get bonuses based on their performance.
Everything's based on that. So that's why they can't have enough. In other words, let's say the average retiree is 65. Try to find me one target date fund that has 65% safe in it. You won't find it because you can't get the yield. And so I would always allocate my own portfolio. And it's not, like I said, it's hard. Remember, take your age. That's the safe part. Normally, you can have a little bit of high yield, how about long bonds, but not in a rising interest rate environment. A couple segments ago, we said go to very short-term kind of cash investments, knowing that you're picking ones that haven't performed as well as the other ones.
Last time you checked a target date fund, doesn't matter what company, ballpark, the aggregate, what was the total fees, you think?
It depends. Some of them are fund of funds. So you'll see like Vanguard is very good at, hey, we only charge 0.06 on this target date fund, but they're buying 5 other funds.
But I mean, ballpark, what do you think the cost is?
If it's not an index type, you're talking 1% possibly around there.
So you can do it on your own or with some guidance.
Yeah.
For the same or less.
You can pick your own funds, and so you control how much is in stocks. In other words, I'm going to retire next year. I don't want 80% of the money in stocks if the 401k is my main source of retirement income, right? You can't be 80%. Think about it right now. You're going to retire in a year. If you're 80% of stocks now, stock market's gone up 9.5 years in a row. 9.5 in a row. If you've got too much of that, obviously there's some danger it could go down. Let's say you've got it all in bonds, but you pick the ones that have yielded the most.
Oh, yeah. I got the good ones.
All of those go down. So you got to pay attention to this stuff. Stay away from target date funds, in my opinion. Obviously, target date funds, there's a place for them. I just think you can do better yourself and just take a little bit more time, because I don't like anything that's not in my control. It could be 80% of stocks when I'm retiring next year, if that's your main source. Now, it's okay to have something like that if you've got tons of other money that you have allocated safely, so it's not going to affect your overall condition, right? That's okay.
And every 65-year-old is different. I mean, for the most part, yes, 65% should be safe, but one guy's got $500,000, one guy's got $5 million, one guy's got $4,000 in expenses, another guy's got 15. Yeah. It's different. It's better at this point in life to have it custom.
And you can go, like I said, that the rule of 100 is 100 minus your age is the most you should have a risk. It's just easier to say your age is the most you have safe.
Right.
Makes sense. An 80-year-old shouldn't be 80% at risk, but 80% safe. You can vary from that. 10, 15% or so. Just if you're a little more risk averse, go a little bit more safe, or vice versa. The problem is you can't go like 30% difference, and that's what people do because they do. Remember that confirmation bias we talked about? They're like, no, I understand stocks and the other stuff.
I read this article here that said that
this guy agreed with me exactly what's going to happen.
It's not the rule of 100; it's the rule of 120.
That's right. And so it's okay to have a little extra, but you're getting extra risk. Don't try to compartmentalize your money. Try to think of it as a whole. What they'll say is, in their mind, people say, well, this account did this. Overall, I must have made 20% a year. And I go, all right, how much money you have 20 years ago? I only had $1 million. How much you got now? 2.5. I go, That's about 4% a year. No, I made 15%. I go, you might have made that on this $200,000 stock account, but your overall portfolio, 1 to 2.5 is 4% a year.
That's right.
But people don't realize it because you get caught up in it. You're thinking about these. You don't even pay attention to the money market. You've had $1 million in money market making 0.1 for the last 5 years, when even low inflation has eaten it up.
And 401ks are worse because you're putting money in, the company's putting money in, you're not quite sure where you are.
401k is the fastest savings vehicle you can ever do. If anybody tells you don't invest in a 401k, or their commercial starts off, we'll beat the pants off of a 401k.
Yeah, that's terrible.
They are not looking out for you. They are looking out for themselves and trying to sell you something. If they all tell you to not do a 401k and buy something else like a life insurance policy, that's what all that stuff is about.
And they've got a great justification. They'll explain it to you.
The reason is you can't buy life insurance policy with retirement money. So they're trying to get you not to do the retirement money so you can buy the life insurance policy, which is absolutely ridiculous. And that's why those are, we call them crooks. Remember, call us if you have any questions. We'd be more than happy to go over anything you've got. It's always great to have a second opinion. 972-715-2424. Again, 972-715-2424. Always go to our website, ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome to our last segment. It's very sad around here. Now we don't do any sound effects, no screaming, no crazy sound effects. But I'm thinking about getting them.
I've got one at home. I've been tempted for the last 5 years to bring it in, and I don't. You remember the old Staples button that says that was easy? You know, the little easy button. I've been wanting to bring it in for 5 years.
My daughter had
one of these days. I will
say this: a toot machine. She thought that would be good on the radio, but I go, well, maybe one time.
Toot machine?
Yeah.
Like the old cushions you'd sit on. And
I said, okay, we'll think about that one. I'll put it. Could you put this on the radio? I could, but
we've had engineers do that. I'm just saying.
All right, we got. Remember how to allocate a 401k. First thing, get the safe money safer by going shorter bonds, right, or money markets. G-fund, anything like that. Stay away from any kind of bond funds that have long bonds or lower yielding bonds. I mean, higher yielding bonds, which mean lower.
Especially now, big time now.
Be careful, because interest rates going up, bonds go down. The longer the maturity, the worse they go down. The lower the rating of the bond, the worse they go down. But those are the ones that have made the most the last 10 years. So if you're looking at 4 choices on a bond thing, stay away from the ones that have made a whole lot in the last. I know that sounds weird, but do that.
I was going to say maybe we can talk a little bit about, unless you've got finishing up a thought, about what is the purpose. I mean, what is the 401k and the IRA? What are they custom tailored for? What do they do best for you?
They're designed for one thing.
Now, there are exceptions, and a lot of people we deal with, because the kids put all their money into their 401k, and they've got huge 401k, and then that's a different story. But if you're the type that has a 401k and you have cash, the 401k is not really set up for emergency money. And the reason we talk about it all the time, you have a $60,000 emergency, you haven't paid tax on this money, how much does it cost you?
It could be up to 37% plus a 10% IRS penalty.
You got to pull $100,000 out of the account to net 60. To pay your bill. Where you're non-qualified, if it's a $60,000 expense, it's a $60,000 expense.
That's right.
So it's not ideal for emergencies. Now, if it's your only option, then you have to. At 70.5, we have to take required minimum distributions, RMDs. The government says, fine, you've had tax-free growth long enough. We want to start getting taxed. Each year, you got to withdraw X amount. Roughly starts at 3.9%, give or take. And they increase it every year so that they can get their taxes. So it is ideal for an income stream.
If you're using an income bucket, that's not a bad bucket to use because it's a forced income stream anyway. In other words, the government's perfect plan would be they drain your 401k the day you die. Because that way they got maximum tax money out of this thing. Because if you kept passing it down to heirs are much younger. They might take 40 years to get their money back.
That's right. Continue.
So that's the way to get the most. So they're going to increase the amount. They're going to make you spend it down. I'm of the opinion that says, all right, if I got this $1 million in a 401k, I know it's going to be drained down with RMDs and all that kind of stuff. If that's the case, why not really get a real good income stream from it and get it guaranteed for life even after it runs out? And so that's a really good way to maximize your money. You just try to maximize certain things, optimize certain levels. Do you want to optimize income? Well, right now I can take this thing and put it in a CD making 2%, $20,000 a year. Still got to take out my RMDs, 3.5%, 4%. So I'm getting a certain amount there. No one is draining. Well, what if I could get $80,000 a year out of that $1 million? And then when it does run out, because it's going to run out, I keep getting $80,000 a year. What if I can still get growth on it? There's all kinds of things. So you can really, if you put the right type of funds in the right buckets, you can really maximize what you have.
And there's some products available out there with guarantees that you can have continuance. You can have them stretched to other people now, which is a brand new thing that just came out in the last 3 or 4 months. So there's unique tools available to help you maximize that income stream.
I mean, there's if you use, let's say you use an after-tax account to create this income stream. You can do that, and that can take care of your income before you're 70 and a half. A lot of people don't realize most people aren't going to touch that 401k until they have to, because they have this outside money that's already taxed. In other words, I don't want to take out 60-cent dollars when I can take out 100-cent dollars over here. Your expenses cost you a lot more when you got to pay tax on it. It could increase your tax brackets significantly.
Absolutely.
So ideally, not everybody can do it, but ideally I want to take it out of the 401k. So you can use non-qualified money to create an income stream in the meantime. But the 401k, to me, I'd rather leave my kids, if I want to leave an inheritance, after-tax money. Because remember, if I leave, let's say I died and left this $1 million 401k to my heirs, 99% of all heirs spend the money within 18 months. All of it.
It's not up to us before we die to say you have to stretch this. When we're gone, they get to make the decision.
That's right. So I'm leaving them 40-cent dollars. Why don't I turn it into some giant income stream that goes forever, putting part of that money, if I don't need it, back into after-tax, so my heirs will get more. My heirs will get more. I'll have more after-tax money. All of those kind of things. Well, that is exactly what you can do if you allocate your money correctly. So when you call us, when you step down, we're going to analyze your different investments and say, this would be ideal for an income bucket. This would be good to inherit to your kids.
Right. This
would be good for your emergency bucket, and confirm all that stuff up. Don't hesitate to call us if you'd like us to take advantage of any of those services or have any questions. 972-715-2424. Again, 972-715-2424. You always go to our website, ilovemyretirement.com. I'm Victor McClure. For Guy Allert, we always, always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.